The last part of this video reveals how this property, if bought now, will make you $741,091 in profit. Stay tuned until the very end and be sure to watch the breakdown of those numbers. I'm going to cover your gross rental income. I'm going to cover your operating expenses, your capital gains tax, your recapture tax, your straight line cost recovery. I'm going to analyze the net present value. You name it, we're going to cover it in this video. So be sure to stay tuned until the end so that you don't miss an opportunity to make $741,091 in profit on a beautiful one row back from the beach, short-term vacation rental multifamily property. Let's get into the video. All right, guys, Brandon here. Now, the property back behind me made $131,160.93 last year. Yes, this is a multifamily duplex right back behind me. It has two separate units. Each unit has 4 bedrooms and 2 bathrooms, and the guy is renting it out 3 different ways on Airbnb and VRBO, which he's making an incredible killing that way. The flexibility is where he's winning. Now, he's renting it out as an 8-bedroom, and he's making a ton of cash. He's renting it out as 2 separate 4-bedroom, 2-bathroom units. So if he can't rent it as separate units, he's written the whole thing, and he's crushing it. The great news is, it is a little dated in some places. In other words, there's room for growth in this business. Additionally, I'm going to show you that the space on the other side of it can be the perfect fit to put in a nice in-ground pool, which will obviously help you grow this business. Guys, we have to dive into the fact that there's no HOA fee here. We have to dive into the fact that that means that you can kind of set your maintenance budget and you don't have to deal with all the crazy town mess of HOAs. We have to dive into the fact that you're able to buy this one property for maybe $100,000, $200,000 more than another property just up the street like it that doesn't have a whole second unit. There's another property selling for $1.4 million just up the street. This property right now is on the market for 1.7, and I would imagine that the seller is flexible. You could pay $100,000, maybe $150,000 more and end up with 2 units here. All right, so enough rambling on my part. You need to watch this video if you're a first-time investor, you're just getting into the commercial space for multifamily, you're looking to do short-term vacation rental properties in our market. This video is for you, and it could be the difference in you making profit or not making profit on your next investment. I'm going to cover all kinds of advantages of buying a multifamily property with 2 units versus buying 2 separate oceanfront condos. Now, guys, we're on site right now in Surfside Beach. We are at Seaside Drive and 5th Avenue. I'm going to take you inside the unit in just a minute, but I did want to take you around it so you can kind of see what's going on just outside of us. That is a beach access right there. See that right there? Beach access, those people climbing on up. Let's take a look what you got going on back behind here. Obviously you can see the parking underneath. Now, as far as the pool area goes, it's just over here. Stairs leading to the back entrance to the top floor unit. And this is where you'd put a pool in. And obviously, pools work for short-term vacation rentals, and especially in that listing description on Airbnb. And here's why. You ready? Let's get our cardio in. Come on. Let's look right over at the neighbor's property. What do they have? Pools. You see? Now this is the entrance. This is not the front entrance. This is the back entrance to the property. And step in this way, as you can see. Very, very nice. Kitchen. A little dated. Can definitely be fixed up. Already generating income and making great money. All right, now, as you can see, guys, dining room, living room, plenty of light coming in. We've got a bedroom to the left and a bedroom to the right, and we also have a washroom. And then back behind me, we have 2 more rooms I'm going to show you. There's a balcony here, as you can see. And there's your door, kind of overlooking things. Let's get in here. Well, can't get in right now, so I'll take you out on the way out, guys. Restroom, as you can see. Of course, your tub shower combo, as you can see. Another room, flat screen TV, closet in the corner. And then your washroom, as you can see. Kitchen's got a nice bar. But let's get over here. So we have a room to our right. We do have the owner's closet right here. Community bathroom that services both rooms, and another room here. Let's take a look. As you can see. Dual vanities, nice shower. Owner's closet, great for your cleaning lady with a little coat on the door. All right, guys, now this also has a view to the front porch balcony, which we'll get to now. So guys, this is your front porch balcony. Now, you can see, connects to that room. The street is absolutely beautiful, adorned with some gorgeous homes. This takes us downstairs. This takes us upstairs. There's another unit right above it. Another 4-bedroom, 2-bathroom unit. Another nice porch. There's your entrance. And I just wanted to stop real quick and show you the view from up here. You can see that ocean right there. Absolutely beautiful. Absolutely stunning. Let's take a gander over here and see what the neighborhood looks like. Not bad at all. So Unit A is the bottom floor, or the first floor. Unit B is the second floor. It's public parking right there. This is the front of this gorgeous listing, as you can see. All right, guys, now this property is located at 412 Seaside Drive. We're right here in Surfside Beach. Now, the owner who's selling this property is also selling another property. If you'll take a look on the right side of your screen, you'll see some of the income numbers I want to cover with you. For 412 Seaside Drive, that's the top set of numbers. You see Holidays by the Sea, and it made $76,688.94. That is the owner renting this unit as an 8-bedroom. Now, next you'll see Holidays by the Sea B, top floor. He rented it as a 4-bedroom, 2-bathroom. That was $24,149.17. And then finally, you have Holidays by the Beach A, first floor. He rented that as a 4-bedroom, 2-bathroom, made $30,322.82. Additionally, you can carry this a little bit forward. He's got it broken down into total Airbnb and total VRBO, as well as total private credit and total private cash. Now, his for Airbnb for Holidays by the Sea as the 8-bedroom, 4-bathroom unit, it was $28,942.94. Again, with just one of those 4.2s, he brought in $12,029.17, and then with another one of the 4.2s, he brought in $22,725.82. And then on VRBO, you can see renting it as a full 8-bedroom, 4-bathroom. He brought in $29,371.27. Again, renting it out separately. He did not do as well on VRBO, again making $5,416 for one unit, 5,317 for another unit. Now, he obviously extended some private credit to some individuals. For his 8-bedroom, 4-bathroom, 10,274.73. Then we have separate units, 5,134, and then again the other separate 4-bedroom, 2-bathroom, 1,480. Finally, he's got total private cash on here. So obviously some people send him some Venmos or some Zelles in order to be able to use this. Now, again, renting it out as a whole, 8-bedroom, 4-bathroom, 8,100. Rented out as a separate unit, we have 1,570, and then finally $800. So guys, what I want to point out is that I want to talk about the additional gross rental income that he was able to bring in through private credit and cash. Because, you know, we have a total private credit of $16,888.73. We have total private cash of $10,470. Guys, that's $27,000 in additional income that he would not have made had he not had a strong sphere of influence and worked his sphere of influence. And that's the whole point here, guys. Yes, you can do well on Airbnb and VRBO. Simultaneously, it will be even sweeter if you do have a strong sphere of influence and you're marketing on your social media channels to your sphere of influence, because that can really help crank up that gross rental income. It looks like this gentleman did very, very well. All right, so let's dive into the numbers right here at 412 Seaside Drive in Surfside Beach. Now, again, the purchase price was $1,750,000. The acquisition cost, we've got you at 4% brokerage fees. That's $70,000. The loan cost and fees was $26,250. We've got you at 2% loan fees of the actual loan amount. The mortgage was $1,312,500. That's 75% of the purchase price. It's got you paying 25% down. So if you take your purchase price, you add in your acquisition cost, you add in your loan cost, you take out your mortgage, you're left with the initial investment of $533,750 to get into this deal. That's the money out of your pocket into this deal. So let's get into the taxable income section of our analysis worksheet. You'll notice that the top line says potential rental income. We've got you at $252,233 for year one. Essentially, if you had 100% occupancy all year long, that's what we estimate you can bring in on this property. Now, vacancy and credit losses. According to AirDNA, it had an occupancy rate of 48%. So we've got you at vacancy and credit losses to the tune of 52%. Now, that's going to bring your effective rental income down to the $131,161. And that is the number that was reported by the seller of the property that he made last year in total income for rentals through Airbnb and VRBO, and as well as his sphere of influence. Now, we take that 131 effective rental income. We add in any other income. Maybe, on some properties you'll have like parking income that you can make. Maybe there's a billboard near the property or somebody pays to put a sign up on it. But in this instance, we didn't have any of that. So your operating expenses were $27,544. Now, if you take out that was 23% roughly of the operating income. Now, if you take the $27,544 from the $131,161 gross operating income, you will be left with a net operating income of as much as $103,617. Now, your interest on the mortgage came out for the first year to $91,239. Keep in mind, all these numbers we are referencing because interest is a write-off for you. This is the taxable income section of the worksheet. Now, your cost recovery for your improvements. That's the depreciation that you're able to write off on this property each year. Now, what we did was we went into the assessor's office, found out what the percentage of the assessor's rated improvements were to the total assessed value of the property to get a percentage in order to calculate a defendable basis with the IRS of what you're writing off on your depreciation. So, for example, in this instance, I think it was 32%. In other words, the assessed value of the improvements was 32% of the total assessed value of the property, because we're using our basis as the assessor's office, it's pretty much hard to argue with, basically. So all that being said, we took that 32%, we multiplied it by the sales price plus the brokerage fees, and that gave us the amount that we were able to depreciate. Now, we also had to take into account mid-month convention when calculating your depreciation. Mid-month convention, in my words, states something to the effect of, in the year of acquisition, we're only going to be able to count 11 and a half months of that purchase time. We're assuming that you purchased it the very first month of the year. And of course, in year 5, we're assuming in the year of disposition that you sold it in the last month. And we're only counting 15 days out of that month and 15 days out of the first month in January for your acquisition year. So we have taken into account mid-month convention. Now, moving right along. Cost or recovery for the year, that's depreciation, came out to $20,931. Then you also have the amortization of your loan costs. We've got 2% of your loan costs spread over 5-year ownership term. That's $5,250 per year. Then you've also got your taxable income. So essentially, we've got you at a taxable income of negative $13,803. If you take your net operating income, you pull out that first mortgage interest because it's a tax write-off. You pull out your depreciation, again, another tax write-off. You pull out your loan cost, again, another tax write-off. You're actually writing off more than you have income to be taxed on. So you're in the negative $13,803. You're in the clear. Ultimately, your tax liability and savings, I've got you doing that at 37% tax bracket, which is 37% of that $13,803, bringing you in at $5,107. Now, for all of the rest of the years, they were calculated the same way. I just took into account a 2% escalation in the gross rent or in the potential rental income based off inflation. So we're just going to say, hey, that your rental rates are going to increase by 2% every year. All right, so now let's work through the cash flow section of this worksheet. This is the actual money that's hitting your pockets that you're seeing. You got your net operating income that comes in at $103,617. You've got your annual debt service. That's 12 months worth of payments on your loan. Comes up to $111,318. If you take the debt service, which is $111,318, from the net operating income of $103,617 that you're bringing in on the property, you are left with a cash flow before taxes of as much as negative $7,701. Now, obviously, your annual debt service is outweighing your net operating income, so the investment is not profitable in the first year, but that's okay. That's okay because we're going to make up for it when we sell the property. Sometimes you run into investments where you have to carry them a while. Now, if as far as tax liability, that was $5,107. If you subtract that from the $7,701, you are left with a cash flow after taxes of negative $2,594. And you'll notice in the corresponding years, until we hit year 4, we actually do not go profitable. And then in year 5, you go up to as much as $395. However, considering how our market has appreciated, considering that this is a value-added property, considering you purchased this property at the right rate, at the right net present value, which we're just about to get into, and the property appreciates very well like it did historically. Just 2 years ago, the property was $800,000. It's now on the market for $1.75 million. So you might not make the money on the annual profits, although I do believe that you can. This property, if it was remodeled and taken care of and ran well, man, yes, you could make some excellent annual profits with it. It's already got a great track record showing that that there's plenty of demand for it. It's just a matter of raising the average annual night rate that you can charge. There's demand. You just need to charge more. So ultimately, I do believe you can make great annual profits on this property. And I do believe it will appreciate very, very well, which you'll see in just a minute. I'll show you some of that appreciation over the next 5 years, and you'll see how this investment pays off. All right, so let's check out the cash flows for the life of this investment. We've got your holding period at 5 years. Year 1, you're shelling out $533,750. Year 2, you're negative $2,594. Year 3, you're negative $1,490. That was year 2. Year 3, you're negative $734. Year 4, you're positive $7. Year 5, you've made $395,000. Now, I'm assuming that in year 6, your cap rate is going to go down by 1% from 6.7%, which is what it is at currently, to 5.7% for this multifamily short-term vacation rental property. Should our market continue to appreciate the way that it's appreciated, I don't believe that that's too much of an ask. It's only 1 point in cap rate. That 1 point difference in cap rate puts your sales price at $741,091 in year 6 when you sell this property at a 10% discount rate. So let's say that you've got to get 10% on your money. The net present value is negative $77,482. What that demonstrates to us is that we need to purchase this property at least $77,482 cheaper than what the initial investment is already, which I would imagine that the seller will be flexible with you on the purchase price, and you can come in and get this property where it needs to be so that you at least make that 10% return on your money. Your IRR was right at just a little over 6.5%. So guys, ultimately, you're making money on this property in the long run in appreciation. Additionally, you can make this property sing. I believe that. Absolutely. It's just a matter of coming in, doing the necessary remodel, doing the right design and decor on this property, and it will be a sure winner on Airbnb and VRBO. It already has a strong track record. So let's take a quick walk to the public beach access so you can see the water, because it is a beautiful day in March right here. The weather feels great, nice cool breeze. It is phenomenal in Surfside Beach. Now, why would you want to buy a multifamily property with 2 units versus buying, let's just say, 2 oceanfront condos that allow you to, all of them allow you to do short-term vacation rentals? Well, I'm going to give you some quick points that might steer you in the direction of purchasing a multifamily duplex. Your first is going to be residential loans for properties that are 2 to 4 units often have lower interest rate and better terms, especially when it comes to compared against what's called a condotel. A condotel, in an oceanfront condo at a beachfront or resort is called a condotel in the financing world. And that is where they have converted a hotel into a condominium. And so basically, it's considered a little bit more risky of an investment, so the interest rate is going to be higher. So if you purchase the multifamily property with 2 to 4 units, you can look out for a much lower interest rate and better terms. I would go that route. Now, you might qualify for owner-occupied financing, which obviously would work out to your advantage if you lived in one of the units. And that's something that a lot of people who are first getting started, a lot of your initial investors take advantage of that. They'll move into one unit, they'll buy it, they'll get a cheaper interest rate, better terms, and they'll rent one out. And it might very well subsidize and take, it very well will hopefully pay for the cost of you living in the other unit, which is a strong advantage for a first-time investor really trying to gain some momentum. All right, now the next thing is you have more control over your operations. One of the immediate things that comes to mind for me is, since you don't have any HOA, you're not going to have any special assessments. You're going to be able to control how much you're spending in the maintenance of this property compared to an oceanfront condo at a beachfront resort. They might tell you, all right, we are replacing all the slider doors, and now you've got a $7,000 or $10,000 bill, and you had no choice in the matter. As where if you have a multifamily property, you're kind of setting the pace at when you fix stuff and how you fix stuff and how expensive it will be for you. Additionally, you don't have any of those surprises. You don't have any kind of surprise rules around rentals, any crazy policies, guests can't use on-site amenities. You don't have to deal with any of that stuff. Another one is lower HOA fees, guys. Lower HOA fees. Now, we've been talking about how this property does not have an HOA. Well, that's great, but what does that really translate into? What does that look like for you? It could look like you saving as much as, $1,200 a month, $1,500 a month, $1,800 a month. And, furthermore, you could be overpaying if you purchased an oceanfront condo at a beachfront resort for some of those on-site amenities. In this instance, you don't have HOA. Now, with a multifamily property like this, 2 to 4 units, you can put in a pool. It's most likely not going to cost you as much as the additional increase that you'd experience owning an oceanfront condo at a beachfront or resort. So you could offer very desirable amenities, outdoor parking, outdoor spaces, fire pits, all that kind of stuff that people look for on Airbnb and VRBO without having all the excessive fees. All right, tax advantages, cost segregation studies. You can accelerate depreciation on a 2 to 4 unit multifamily property, and potentially your write-offs are going to be better on maintenance, repairs, and capital improvements for a multifamily property, and you don't have the hassle of HOA fees, which is absolutely huge. Some of you high income earning professionals could see as much as a $30,000, $40,000 write-off just in 1 year by doing a cost segregation study. I can't stress this enough. Depreciating real estate is one of the chief primary cornerstone advantages of purchasing and investing in a hard asset. So you definitely want to get with a CPA that specializes in a cost segregation study and look into that for your multifamily purchase. Finally, guys, you can take advantage of 1031 like-kind exchanges when scaling your portfolio if that's what you choose. You definitely need to get with experts, a CPA, and someone who handles those type transactions to make sure and see if it would be a good fit for you to do a 1031 like-kind exchange. Essentially, guys, in a nutshell, and I'm not a CPA, but I'll throw it out there, you're simply going to be selling one property, putting it in an exchange. You can purchase a property up to 200% more of the value of the property that you sold, your subject property, and then you purchase a new property, and you're essentially deferring your capital gains. That is a 1031 like-kind exchange. Now, yes, are there more nuances to it? For sure, but in very simplistic terms, that's what it is. And you need to see if doing a 1031 like-kind exchange is a viable option and would be a smart strategy when it comes to taxes. Get with your CPA and see if that would be a smart move for you. I like this one a lot, guys. Operational efficiencies. If you've got 2 units here versus buying 2 different oceanfront condos, you're going to get some operational efficiencies. Managing 2 units in one location versus managing 2 units that are in 2 separate locations, you're not going to be able to get the operational efficiencies with having 2 units in 2 separate locations. So doing 2 different oceanfront condos at beachfront or resorts is not going to give you the advantages of having a multifamily property with 2 units in one location. There's no way around it. You're able to streamline your maintenance. With the multifamily property, you can streamline maintenance, cleaning, guest turnovers, and essentially you can cut down cost and increase profitability. Now, let's talk just a little bit more about that. If you set up your rentals to allow for only 1 week stays and the turnover time is the same for both of your units, well, your cleaning crew can come in at one time and clean both of the units instead of having to clean one, on Friday and then one on Sunday. So, and that is a common thing that we see in the Myrtle Beach market. So I would tell you that if you negotiate with your cleaning people and say, hey, if I can get all the cleanings at the same time, the same date, can you cut me a discount? Can you give me a break? Absolutely, guys. It's certainly a way to streamline your cleaning costs. Of course, we save the best for last. There is higher potential for equity growth in a multifamily property when compared to an oceanfront condo. Essentially, you can force appreciation because multifamily properties are their values based off of income. It uses a cap rate. Essentially, by increasing the net operating income, obviously getting more rentals on your books, marketing your property better, you're going to ultimately increase the value of the property. So if you can get more income in your unit through marketing, through selling that unit, through being about your business, obviously you can increase the value of it and how well it appreciates over time. That simple and that easy. Now, condos, by contrast, appreciate more like residential property sales. So you're not going to be able to force appreciation as much. Now, have I seen examples where people have been able to force appreciation through gross rental income increases? Absolutely. There was a 1-bedroom, 1-bathroom oceanfront condo over at the Caribbean Resort that made $72,000 in gross rental income in 1 year. When they sold their property, they bought it for $150,000. 2 years later, they sold it for $268,000. In the meantime, they made $72,000 renting it out. And because the gross rental income was so high on that, what investor wouldn't buy that property at a premium knowing he's going to get it back over the long haul? So they were able to sell that property 13% higher than the average property that sold at the Caribbean at that time. So do oceanfront condos, are they competitive with forcing appreciation through income increases and streamlining, cutting expenses? Yes, a little bit. Are they as competitive? I would say no. Commercial multifamily properties, you're really going to be, the whole space is about that cap rate, is about the income. So you're more likely to find investors that will pay a premium for a multifamily property due to its increased income as opposed to oceanfront condos. All right, so let's take a look real quick just at that mortgage data. The amount of that mortgage, again, was $1,312,500. That is 75% of the purchase price. It's assuming that you're going to pay 25% down. Your interest rate was 7%. Your amortization period was 25 years. Your loan term was 5 years. In other words, you are going to have to either find more financing in 5 years or have this property paid off in 5 years or sell this property in that 5th year before that 6th year. Those are your options. And you do have to be careful there because some people get stuck with not being able to afford the property 5 years after they purchased it if interest rates have risen and their income hasn't risen respectively, to be able to afford a higher financing cost in that 6th year, 7th year when they have to go and find new financing for the property. So definitely something to be thinking about and to be aware of. You want to make sure you have plenty of margin there. Now, payments per year, 12 payments per year. Your periodic payment, that's your monthly payment, $9,276.48. Your annual debt service was $111,317.76. And your loan fees and cost were $26,250. That is 2% of the mortgage. Now let's really quick, guys, check out the alternative cash sales worksheet. Your basis at acquisition was $1,820,000. That is going to be the projected sales price plus your brokerage fees of 4% for getting the property listed and sold. Now, your cost of recovery or depreciation for the entire 5-year term totaled $107,375. If you take your depreciation out of the basis at acquisition, you are left with the adjusted basis at sale. And that's going to be $1,712,625. Now, the second calculation that this spreadsheet takes into account is the calculation of the capital gain on sale. That's what we're going to work through now. Your sales price was $2,286,508. Now, how I arrived at that price is I took the 6th year net operating income and divided it by that 5.7% cap rate to find the value of the property. Again, that was $2,286,508. Your cost of sale was $91,460. That's 4% of that $2.2 million sales price. We drop in our adjusted basis at sale, again, which we calculated already, which was the $1,712,625. And if we take out our adjusted basis at sale as well as the cost of sale from the $2.2 million, we are left with a gain of $482,423. Now, from there, if we take out the depreciation that we experienced over the 5-year term, well, if you take that $107,375, that depreciation from that $482,423, you're going to be left with the capital gain from appreciation on the sale, and that is $375,048. Now, our loan fees, again, we've already covered this, were $26,250. That was at 2% of the loan, 2% of the mortgage over the 5-year period. Well, for the full 5 years, it does come up to that $26,250. We're going to take that from the $375,48, the capital gain from appreciation, and we're going to be left with ordinary taxable income to the tune of $348,798. Now, the final calculation on this spreadsheet is going to be the calculation of the sales proceeds after tax. We've got our sales price at $2,286,508. We do have a cost of sale of $91,460. That's those brokerage fees of 4%. We do have our mortgage balance. We're going to subtract our brokerage fees and subtract our mortgage balance to arrive at our sales proceeds before tax of $971,999. Our ordinary income tax at 37% of our income was $129.55. That was, of course, 37% of line 16, which you'll see there was ordinary taxable income at $348,798. Now, your tax straight line recapture rate of 25%, that is the cost of recovery taken over 5 years. The government, the IRS, is going to charge you a 25% rate tax on, it's called recapture tax, on the depreciation that you took over the 5-year term or the life of this investment. In this instance, it is 5 years. So 25% of line 11, which was $107,375, comes out to $26,844. And then next we have our tax on capital gain, which is 20% of line 13. That was $75,010. Line 13 was, again, that $375,048. That's the capital gain on appreciation. The IRS is also going to charge you a tax of 20% on your capital gain for recapture. So even though they gave you a massive deduction, they want a piece of both your depreciation and a piece of your capital gain. Now, we're going to go back up to that sales proceeds before tax. We're going to take away the ordinary income tax at 37%. Your tax bracket might be different. I just used 37%. So we're going to take that from the $971,999. We're going to take out the straight line recapture tax of 25%, the $26,844. We're going to take out the capital gain recapture tax of $75,10, and we're finally going to be left with a sales proceeds after tax of $741,091. Guys, now some investments are like this. You have investments where it doesn't make a lot of money while you carry the property. Quite possibly, if you do come in, remodel of the unit, do the right paint, the right decor, and really spruce it up, you can definitely increase those annual profits and bring in some better cash flows throughout the year. However, the appreciation on the end of this property, being that Myrtle Beach has been the fastest growing market out of the 150 most populated markets for the last 3 years in a row in the entire United States, the growth that we are experiencing in our market is nuts. Baby boomers are retiring at a rate of 10,000 per day, and they're moving to Myrtle Beach into Florida, and they've discovered that they get more for their money in Myrtle Beach than they do in Florida. So our market is blowing up. I believe it's safe to say that you will, if our current cap rate is 6.7%, it could drop 1% in the next 5 years when you buy and hold this property. So you could walk away with as much as over $700,000 in appreciation. Much like the current owner of this property, in 2022, this property sold at $800,000. Look how much it's appreciated. That's the point, guys. And this is a deal compared to some of the other properties that are on the market just nearby. Some other multifamily properties selling for $1.4 million. You're getting a whole nother unit, a whole second unit that you can rent out, which gives you a lot of flexibility. This property is posed to make somebody an incredible amount of money if they buy it and hold it for 5 years, so long as our market appreciates. Now, I get calls and emails every day from investors like you looking to invest in commercial properties. I don't care if it's a multifamily property, an industrial property, a retail property, a hospitality, it's a hotel, whatever it is, get in contact with me. Send me a text message, shoot me an email, hop on a live Zoom conference call with me, call me. Let's run the numbers on your deal. Let's do a market analysis, a financial analysis, a feasibility study. You're working with a qualified professional that can run that type of analysis for you so that you make a savvy investment decision. If you're a first-time investor, you definitely want to give me a call. If you're a seasoned investor, I'm pretty sure we can both learn from each other and grow in the process. 843-360-1737. Let's have some fun and get your deal done.